Well, Alan, thank you so much for joining us here. Just to give you guys a quick introduction of our club and our purpose before diving in, we're the Finding Finance Association. Our mission is to educate you students about the different career opportunities in finance by bringing in guest speakers to discuss their backgrounds so that you can gain some clarity as to what might be best for you. So, with that said, I'm pleased to introduce Mr. Alan Schrager from Oak Hill Advisors. He's a senior partner and portfolio manager there, leading their private credit division. He attended University of Michigan for his undergraduate degree and the Wharton School for his MBA. So if you could give a quick introduction of yourself before we dive in, that would be great.
Sure. Well, really nice for everyone to be here. Great to meet you, and looking forward to this. And I'm looking forward to answering questions from everyone to the extent you have anything. So, my name is Alan Schrager, and I've been working in finance for 35 years, almost 35 years. I've been at Oak Hill for 21 years. I'm going to correct a little bit of what you said, although not too much. So I basically run sort of our entire investing business, which for what Oak Hill does is below investment grade credit. So we do a lot of different things. Private credit has a sort of a word that doesn't really necessarily mean anything. People sometimes call private credit a lot of different things. So I sort of generally describe what we do a little bit more specifically, which is anything with companies that are below investment grade. And if people don't know what that is, you should raise your hand and ask. I can clarify that. But what we do is bank loans, high yield, what used to be called junk bonds, mezzanine, everything from performing credit to distressed, primarily North America and Europe. And then we do a lot of multi-strat, and then obviously this sort of amorphous phrase, private credit, which fits a variety of different things, including direct lending, special situations, and even some people think about that in terms of distress. We've got all of that. We manage about $70 billion in equity. And when I asked the class yesterday, I taught 3 classes yesterday. I don't know if anybody was here. Anybody up? Yeah, I see one. So I taught 3 classes yesterday, and when I started, I said, we manage $70 billion in equity, but we sort of manage $100 billion of assets. And I asked the question of somebody tell me what the difference between those 2 numbers was, and that's incremental leverage that we borrow. So we manage about $100 billion in total of assets across all of the asset classes that we cover. And there's about 450 people. I manage an investment team of about 125, and I chair all of our investment committees. And we spent a lot of time in what has been talked about in the press as private credit. It's been sort of the changed name from direct lending to private credit. So if people are talking about that as a direct function, we've transitioned a lot of the capital that we have that used to be multi-strat to invest across anything that we do. And given how attractive private credit has been over the last 5 years, we've focused a lot on that. So I can talk about a variety of different asset classes and a variety of different jobs across Wall Street. I was an investment banker. I've worked in merchant banking. I've done a variety of different investing. And then I touched private equity pretty significantly in my role, although I've actually never worked at a private equity firm. And I think that's pretty much it.
Awesome.
So I was obviously honored to be asked to come present. And I didn't realize I was the inaugural in-person presenter. So
Yeah, well, we're honored to have you as our first in-person speaker over the past 3 years. So that's great. So if you could walk us through your background starting in college,
Right.
and maybe going into a bit more detail on each step of the way that led you to where you are today.
Sure. Which class were you in? Were you case study or the
first one.
The first one. Okay. So you've heard a little bit of this. So started at the University of Michigan and graduated in 1990. One of my claims to fame is that I was the manager of the Michigan basketball team when I was there, and happened to have won the national championship. So I actually have a national championship ring and was on TV a lot, and big basketball fan, big Michigan basketball fan. Was grappling with where I wanted to go at my senior year. Back then, recruiting started like the second semester of your senior year. Now they're like recruiting you when you're in high school for your full-time jobs. It's so crazy how that is accelerated. But so back then, I finished my junior year, won the national championship, and I was trying to figure out what I wanted to do in my life and in my career. I was choosing between a job in basketball. I had a job to go work at Arizona State as a graduate assistant and going to Wall Street. And I chose to go to Wall Street, which considering Arizona State never won a national championship after that, maybe it's a good decision, who knows. But regardless, I started as an analyst in investment banking at what was then Chase Manhattan Bank, which is obviously now JP Morgan Chase or JP Morgan, depending on which division you think about that. I did training there for a while, and then I joined a group, in essence, a variety of different groups. I rotated through that, which is pretty typical even today. It's pretty typical that the banks will rotate you through the groups. We actually hire 12 people a year, and we put them in an industry group and tend to keep them in that industry group for their first 3 years, so they sort of learn something from the same people. But back then you would move around a little bit. And so I worked there for 3 years, and I left and traveled for about a year. Traveled the world, and it was really my first exposure to anything outside of the United States, which was a great experience and sort of impacted me for the rest of my life and career. I remember being on the road in a payphone in New Zealand when my mother picked up the phone, and before she said hello or allowed my father to get on the phone, screamed, "You got it to Wharton!" So I knew from then that I was going to Wharton. I had already gone I had gotten into Columbia and a few other schools, and I applied to Wharton and Kellogg from the road, or at least before I went to travel. So I went to Wharton. As you heard the joke, I bleed blue, so I think of myself as a Michigan person. If you asked me where I went to school, I would tell you I went to the University of Michigan and went to business school in Philadelphia, because you sort of get very loyal to your undergrad. Hopefully all you guys feel that same way, but I definitely felt that way. And so I went to business school, and I was deciding again, was I going to go to Wall Street, back to Wall Street, or do something different? And it's one of the lessons I sort of learned, although I'm not sure I regret it, but you sort of get caught up in what's natural, what everyone else is doing. So everyone was applying for Wall Street jobs. They were the first people to come on campus. They were very aggressive in terms of offering jobs and then giving you exploding offers. And I sort of ended up in a job before I even realized I had one, working what was originally supposed to be Salomon, and then and probably you guys haven't even heard of Salomon because it's been gone for so long. But it was one of the prestigious investment banks, and then a whole group of them went to work at UBS, and I followed them at UBS. I did banking there for a little while, and then I left to go to a small firm, which was a spin out of Drexel, which was where Mike Milken worked. How many people have heard of Drexel Burnham or Mike Milken? Not that many, so we can do a history lesson on that, but he's sort of the founder of what I do. Mike Milken, notwithstanding the fact that he ended up going to jail in a real regulatory overhaul during the late 80s and early 90s when the recession kicked in and there was a lot of issues with the S&L crisis. This was somebody who was the number 2 person to Mike at Drexel, started his own firm, and I thought it'd be super cool to go work at a small place. We were doing investing and advising. The firm was called Libra. Doesn't exist anymore. It was actually bought by Houlihan Lokey. But at the time, it was a really fun place to work, where we'd invest in companies. It's actually my first exposure to St. Louis. We invested in a business here, and I moved here to run that business for a while. Actually taught I guest lectured in one class at Olin, which I believe was called Olin at the time. How long has Olin been called Olin?
I think it's been called Olin for a very long time.
Very long time. So it was probably Olin at the time. But regardless, I was in St. Louis for a year, ran a company, sold it, moved to LA, which is where Drexel had been based and where Libra was based. And then for family reasons, personal reasons, I wanted to move back to New York and sort of had a variety of different job opportunities in both private equity and alternative credit, which is where I am right now. And I took the job at Oak Hill almost 21 years ago, certainly a little bit more than 21 years ago now. And I've been at Oak Hill now for 21 years. At the time, we were 30 people and $3.5 billion. And now, as I said, we're 450 people and $70 billion using like-for-like equity to equity. And I've been there, and I've sort of run everything along the way. I always talk about myself being sort of the personification of Oak Hill, which is I've run a variety of the different businesses that we have. I started as an analyst covering different industries. I started our software business, which is now our largest industry, and then got promoted to portfolio manager, and then ran a variety of different things, some of which you'll probably ask me about, so I don't need to go into that much. But I really started our software business. I started our multi-strat business. I ran our performing business. I co-ran our distressed business. I co-ran our opportunistic business, and now I run our private credit business, our multi-strat, and oversee the rest of the investment business.
Wow.
That was a long introduction. I apologize for that, but that's the career. I guess when you're an old guy, you have a lot of things that you've done.
Awesome. So before we fill the gap between how you went from $3.5 billion to now 70, if we could hear sort of at each inflection point when you were deciding between basketball and Wall Street and then after your MBA, at each of these inflection points, how did you decide on your next move and what guided you to make those decisions?
So, great question. So, I've sort of always been driven by what's sort of fun and interesting to do. So, basketball versus Wall Street was relatively easy. I helped recruit the Fab Five at Michigan, and I will say that recruiting was something I never ever wanted to do again. And so, if you were going to refuse to recruit, clearly becoming a college basketball coach wasn't something that was in the future. So I didn't love that part of it, and I justified the fact that we had already won a national championship, and so what did I have left to sort of achieve in that regard? Not that I actually shot a basket or did anything other than play in practice, or at least do some of it in practice. So Wall Street was easy. I was from New York. My father was in human resources. He had never really done sort of deal making and banking, but he was, was able to help me in terms of identifying where and how I would, operate on Wall Street. So that sort of fell into the obvious terms. It was after business school, as I said, it was sort of this momentum of everyone looking. It was easy. Tech was picking up in 1996 when I graduated business school. So all of these banks were offering a lot of money to come work for them because they were losing all these kids to the tech bubble, which obviously burst 5 years later, or 4 years later. But it was, at the time, it was sort of this attractive, go back to New York, something I knew how to do, pay a bunch of money to pay off my loans, and sort of move on. So those decisions were sort of easy, although they sound relatively superficial when I actually repeat them, but at the time, it wasn't like I gave a lot of thought. After that, the decisions became a little harder, and I've actually had, even over the course of my career, while it sounds like I went from, in essence, UBS to Libra to Oak Hill, there were a variety of decision points along the way, times where was offered jobs to leave Oak Hill, times where I was offered jobs to leave UBS and Libra, I guess. And I chose most of the time the decisions were based on how interesting was the job going to be, and who were the people I was going to work with and for, and how much did I respect them and like them. And those two things have never hurt. Like when I left UBS, to try to keep me at UBS, they offered a variety of different promotions and money, but I really, really liked the team that was leaving to go join Libra. I really liked the guy who ran Libra, who's still a mentor of mine and still a good friend. And I thought that was a really interesting thing to do. It was like not banking anymore. It was investing and more, again, private credit's a fake name. Merchant banking is also a fake name. Doesn't mean anything. But it was merchant banking, so it sounded different. And so I did that and made that decision based entirely on how interesting and different it sounded, and then the people. I took the opportunity to work here, which I did actually in a convoluted way, which is not worth going over. But so when I don't include that as an actual job, it was actually part of my Libra job, although it was actually set up differently. Again, neither interesting and not worth the time. But I did that because I thought it was going to be super fun to run a business. I had never done anything like that. I got a lot of exposure to a lot of different people that I wouldn't have been exposed to. And I learned that running a business is really hard and super rewarding. But that business, as the bubble approached, became harder and harder to run, and so we ended up selling that business. And I just really went back to work for Jess at Libra because I had loved when I was there, and I really wanted to go back. It was the big transition back to New York in 2003. That was the real decision, and I had a variety of different opportunities that I was looking at pursuing. I knew I didn't want to go back into banking. I didn't love having clients. I liked being the client more, and I got a little bit of that at Libra to let me know that I wanted to go to the buy side and sell instead of the sell side. And that decision was the hardest decision. Where do I go? What exactly do I do? What part of the market do I want to attack? And what I realized with the private equity opportunities I had is I wasn't really an equity guy, right? The glass is not half empty or half full in my house. It's completely empty and the glass is broken on the floor. So if you were an equity guy, you sort of had to see the end game. And there's obviously absolutely phenomenal jobs and great opportunities in private equity. It just wasn't my personality. It wasn't what I was going to be good at, I thought. And so I made the decision to go with the best place in what I thought I would like as much, which was Oak Hill. And notwithstanding bumps along the road, because there's always bumps along the road in 21 years, I've obviously been there 21 years, which is, I'm guessing, relatively longer than most of you, if not all of you, have been alive. So it's a pretty decent stretch.
Yeah, not too far off. I think that's longer than most of us have been alive.
Yes.
So could you walk us through how your role within Oak Hill changed from when you first arrived 21 years ago to today? You led multiple different segments within the firm. If you could delve into each of those and maybe explain what that role was so that we can have a better sense for what is out there, that would be great.
Perfect. So that's a longer conversation. I'm going to try to make it interesting. I'm not sure how interesting it is, so I will be careful to not go too long on this. So I joined. What I had in essence been doing was investing in middle market companies, which was what private credit was at the time, which was primarily a middle market financing business. And so I was hired by Oak Hill to start a private credit middle market business in 2003. And I was also going to cover a few industries along the way. And if you think about how we're structured, we're actually still structured this way. We've got industry specialists. At the time, there was one person per industry. There's now 8. which just shows you sort of the growth in the market as well as the growth in the firm. But each of the individual industries at the time had one person, and I was in charge of waste, which you'll get the chance to participate in tomorrow, and as well as a couple of other minor industries. But I was the new guy, so I got the shitty industries because why would anybody else give up a good industry? So I was trying to start a private credit business, and I was covering a couple of the lower tier industries while I was there. And what I realized relatively early on is that Oak Hill, especially my boss, who had my job at the time, or was me at the time, who ran in essence the investing business and sort of approved everything, didn't particularly like middle market companies. And I was coming to him with middle market opportunities, and we defined those at the time as sort of $50 million of EBITDA and less. We call that $75 million now. I guess you could call that inflation. But it's $50 million and less. And I was bringing a bunch of ideas and things I had generated through relationships of mine and sourcing that I had, and he was not happy with any of them. We ended up doing a few of them. They actually turned out to work out really well. But they are tough deals relative to what Oak Hill had traditionally done, which was larger companies, which had a little bit less volatility and a little less uncertainty to them. And so I realized I'm sitting there, I'm newly married, just bought a house, and I wasn't sure if I was going to have a job, 6 months later, because I couldn't figure out exactly what my job was going to be. At the time, I was sort of oblivious. One of the things you will learn as you start your careers is communication is not as good as you would hope. Nobody sits there and tells you you're doing a good job, you're doing a bad job. Nobody's telling you this is where we're going to grow, right? When you're 21, 22, 23 years old at the time, I was in my 30s, but I was still the new guy. I had no real concept of how I was perceived or anything. I'm not sure I was in any jeopardy of losing my job, but I was definitely scared I was going to. And so I'm looking around trying to figure out, what do I do? Like, I got to figure out how to add some value. I'm sitting in my office trying to pretend that I'm really busy because the things that I really was doing were not as accepted. And the tech bubble had burst a couple of years earlier, and a new deal came in, which was, oh God, now I'm blanking on the name. I can't believe I'm blanking on the name. SunGard was a new software deal came in. It was basically software tech came in, and we didn't have a software tech analyst. And I said, well, I'll look at it. And they're like, well, we're never going to do software. God, if you thought we weren't going to do middle market, you are smoking dope if you think we're going to do a software deal, 2 years after the crisis ends. And, 2000 is 2004, so I take over the software business, and a few things start coming. I start using my sourcing networks to create deals that are software-oriented deals, but are larger companies. So, and what I do is I sit down and I write what's now actually still called, and it's still actually present at Oak Hill, the Software Bible. And I wrote a 10-page, in essence, white paper explaining why everyone misunderstood software debt relative to the equity market that they were looking at, why it was a great place to invest, and presented it to the CIO, to Scott, who's the person who was basically running the portfolios at the time. And he said, okay, this doesn't seem as stupid as I thought. Let's do a little bit of this and figure it out. And within 2 years, we had probably increased from $3.5 billion when I started to $5, $6, $7 billion, and we had almost $1 billion in software by the end of those 2 years. I had truly convinced him that this was sticky, stable, sort of eligible for debt financing, and he bought into it. And we were able to differentiate ourselves because nobody else was looking at it, so we were able to sort of charge premium pricing, and it was a real advantage. Ultimately got me promoted to portfolio manager, which is what happened in 2005, 2006. I became his junior, we were obviously much smaller. Now we have 12 portfolio managers. We actually probably have 16 portfolio managers by title, but we have got 12 who actually manage portfolios. But at the time, I was the assistant portfolio manager for CLOs, and before he created this title because he didn't want everyone else to be pissed off that I had been promoted ahead of a lot of them, even though they had been there longer, which seemed irrelevant to me, but he was all concerned about that, so they gave me some BS title. But I was in essence his number two. And his number two, as the business continued to grow and we started expanding what we were doing, suddenly became, I was sort of running our performing business, which was primarily loans at the time, although some high yield. And he was doing, we started a hedge fund, and he was really focused more on the hedge fund, and I was running the performing business alone, even though I was, in essence, his number two guy. In 2006, we started realizing the world was doing some stupid things. And while we didn't anticipate the crisis, and we had no real insight specifically into mortgages or what was happening with the banks or the insurance companies, we realized that people were doing some crazy things. And we started to get really defensively positioned. We actually raised a $2 billion distress fund that until the market cracked, we weren't allowed to draw down capital, which in 2008 made us look really smart. But in 2007, everyone was like, why are you raising this money? You don't get paid on it at all. And, the world is sort of flying. What are you doing? But we got defensively positioned. And in 2008, when the world cracked, we had all this money to deploy, which most people were actually drowning because the crisis, everyone was pulling their money back in. And we had been defensively positioned, so we were performing well, and sort of started our explosion in terms of raising capital. We raised a ton of money in 2009 and 2010 because of how we had performed in 2008. We didn't do the full introduction, so in full disclosure, my son is sitting right here, who's a freshman at WashU, which is one of the reasons why I'm in person and not on video, is obviously to come hang out with him a little bit as well. And as we were walking over here, he said, I don't understand why you never tell the Infor story when you tell the story of how this grows. So I'm going to tell the Infor story. And it is a stale story, so for anybody who watches this is obviously 2008, the end of 2008. Anyway, the market gets absolutely clobbered. As most of you have probably read, obviously none of you will know, but have looked back. Global financial crisis, we could spend an entire session on just the global financial crisis and what happened. But I'll go quickly to this. So I had obviously covered software, started the software business. I had handed it off at that point because I was portfolio manager, but I was still mostly active in covering the sector. I had most of the relationships, and a lot of the portfolio was software at that point. And we had a company called Infor, which had traded significantly down with the crisis. And this is actually what got me promoted to partner, so it does fit into this theme of my history. It's the end of 2008, and they had second liens, which were second lien loans, for those of you who don't know, but in essence, junior loans in the capital structure. I remember specifically LIBOR plus 700, LIBOR plus 725, and they were trading at 20. So we trade on a basis of par. Par is 100. So they were trading at 1/5 of their claim. They were trading at 20, and I thought they were the best thing that we could possibly ever buy. Good company, well run, high cash flowing business, software, so sticky. Yes, they were getting impacted by the global financial crisis, but my view was that they were going to rebound. And they were yielding LIBOR plus 700. LIBOR at the time was basically 1. So you were getting 8 points every year, and they were free cash flow positive. And they were a 2012 maturity. So it's 2008, I'm doing the math in my head, and I'm saying to myself, okay, well, at the very least, I'm getting 8 points for 4 years. That's 32. I'm buying them at 20. I'm making a pretty good return, and the company doesn't even have to survive. It just has to basically survive till its maturity, and then go and become worthless. And I walk into the CIO's office, and the founder, who ran the distress business, still runs the distress business actually, and walked into their office, and I said, "We have to buy this. We got to buy it." And they're like, the world's coming to an end, and you're throwing us a software company trading at 20. Again, what are you smoking here, kiddo? And I said, "This is my analysis. This is my thought. I think we're going to get par back on this, but regardless, you're going to get somewhere between 24 and 32 points, and you're paying somewhere between 18 and 20. Regardless, they said I was stupid and told me to leave the office. And I said, okay, well, if you're not going to buy them, I want to take my entire bonus and just buy in 4 seconds with my entire bonus. So take every penny you're going to give me for this next year and just give it to me in 4 seconds. That's how I want to get my bonus. I don't need cash. My kids don't need to eat. I'm gonna figure out." So they said, "Well, are you serious?" I said, "Yeah, of course I'm serious." And they sort of reconvened, and the three of us debated, and we ended up buying in 4 seconds. And at the end, we owned $600 million of in 4 seconds, somewhere between 16 cents and 22 cents, which 3 years later paid off at par. And was the most successful investment in Inforce history, Oak Hill's history. Up to that point, it's actually been surpassed since, which makes me happy, but also pisses me off. And so we did. So that got me promoted to partner that next year, and from then the story is relatively boring. Although that story might have been boring, but the story is relatively boring. I just kept sort of taking more and more of the organization in terms of things that I covered. I maintained sort of running our performing business. I took over our multi-strat business, which was in essence investing across the entire capital structure. And over the last, in essence, 15 years, I've sort of evolved as I run more and more of the business and sort of work with Glenn August, who's the founder, who runs the Stress business, to sort of, really sort of run our investing business day to day. And I've touched all different asset classes and all different kinds of transactions. So a few different stories in there. You obviously have the oil crisis of 14 you've got for COVID, but you can ask me about those if you want to talk about specifically about those. But as a career matter, that was really the transitional part of my career was 2003 to 2009. Everything else has been more of a natural evolution of just taking on more responsibilities. The firm has grown, and as I've grown at the firm.
Amazing. So it seems like the biggest jumps in your career came from making high conviction decisions that are contrary to what your team believed that turned out to be true, more or less. So
that specific one for sure. There's definitely others where it's usually a consensus place. I mean, candidly, we got to a consensus place. It just took me a little bit more time to actually do that. But the fact remains is that I along the way, did a lot of investing in almost every case. It's not only high conviction, but it's teamwork oriented in terms of making a decision with the team in terms of what you think is the best investment. At the time, the team was very small, so there was no team. Now the teams are much bigger. You're making decisions with a lot more people.
Amazing. So in that same light, on top of the decision making, what other attributes would you say helped you advance in your career the most? And maybe more specific to our audience, at a young age and at a junior level, what are the most important attributes for someone in our positions to have to succeed and continue to advance their careers?
So, of our 450 employees, we've got about 125 investment professionals, and about 40 or 50 of them, I don't know specifically, but somewhere between 40 and 50 of them are 26 and under. Almost all of them have joined out of college and have stayed at Oak Hill for the entirety of their career. because if we hire them out of college and they haven't left, they're obviously in that category. And so I actually have a reasonable amount of exposure to people who are starting out in their career, notwithstanding the fact that I sound and look old. I do get a reasonable amount of understanding of what it takes to succeed. And, you know, the first thing I always say is that you have to work hard. I start with the advice that you need to choose a job you love, because the only way you're going to work as hard as you need to be successful is to love what you're doing. And so you sort of have to start with that premise that you enjoy the business of that business. And that's the most important part, because the major, especially early in your career, the major driver of your success is working hard. There are some really, really smart people out there, but to be really, really smart in a place where a lot of really smart people exist is hard to differentiate yourself. So the hard workers not only differentiate themselves a little bit, because it's not everyone who works that hard, although there are a lot of people who work hard, but when you take that hard work and you apply two individual parts to it, which is learning as much as you can, which obviously makes you ready for the next stage in your career, which is as you go from being the grunt and the lowest level person to the person who's actually thinking, you actually understand what you're doing. And that's that second part, which is after you've worked a 12, 13, 14, 15, 16, whatever the day is, and I don't want to scare in one direction or another. Some people work really, really hard during that 10-hour day, and some people work hard on that 15, 16-hour day. There's two things you need to do. You need to obviously learn what you're doing and what's happening around you, and you need to be able to apply that. What does the apply mean? That means that, from my perspective, the people who are the most successful as our juniors are the ones who, after they've done their job, and they've done all of the analysis and the work and the grunts and the copying and this and that, whatever you have to do, whether you're investment banking or investments or wherever it is, they take a step back and they look at what they did and they say, first of all, does it make sense? Because the best way you're going to catch a mistake that you made is by actually pulling back for a second and realizing, what did I do and does it make sense, right? This company started with $50 million of EBITDA. Obviously, we don't do $50 million of EBITDA, but just to make the math easy. $50 million of EBITDA, and I projected the model, and in 5 years, they have $1 billion of EBITDA. Does that make any sense? No, that doesn't make any sense. Now, what does that mean? It probably means you have a mistake in your model, right? And so when you hand that to the next person who's not actually in the guts of the model, but is going to actually look at the sheet of paper, whether that's the associate or the VP or whomever it is, hopefully it doesn't get to me looking like that, they're going to look at that and they're going to say, this is wrong. I don't know what math mistake you made, but you made something wrong. So the first thing you have to do when you're working that hard is you have to take a step back to say, okay, does this make sense? The second thing, which is the differentiator in my mind between the people who are really good analysts and the people who become successful in investing or banking or whatever it is they take that step back and not only do they analyze whether they made a mistake, but they understand what's on the sheet of paper. Why did I do this? Right? That company grew from $50 to $150 million of EBITDA. What does that say about the investment? What will Alan say when I present to him as this opportunity? What's my VP and my associate going to say when they're thinking about the questions they're going to ask? And the difference between the grunt and the person who explains, and I'm making up the word grunt, it doesn't sound very positive, but just this concept of the grunt work, and the person who sort of understands what that grunt work actually created and what it means is the difference in my mind between succeeding at the low-level job and being able to move up. So the first piece of advice I always give is do what you love and work really hard at it. The second piece of advice I always give is spend as much time after you've spent all of that time doing the actual job, trying to figure out actually what you've created. You know, it's like the painter who paints and never actually takes a step back and says, what did I paint? Like, what's the painting look like? And that's what I think really differentiates people and can create real success for people.
Amazing. So you detailed for us what makes someone successful once they're at your firm. But a question that's on a lot of students' minds is how can I get into the firm to begin with? So in terms of interviewing, preparation, networking, what hard skills should they have before they go to your firm to work versus what do you expect them to learn on the job? How should students think about what they can control and then what they'll learn?
So the first piece of advice, which I think you guys have already realized depending on sort of the level, I know there's a variety of different classes in the room here, is, as I joked earlier, the process starts earlier and earlier. So you guys have to start earlier and earlier. You have to start making connections sooner. You need to start pursuing what you want to do sooner. I think sort of unfair and probably not to anyone's benefit other than a few firms that sort of started this process every year earlier and earlier. But you need to start preparing for your career earlier than you ever needed to. And that means that as a freshman and a sophomore, you have to start thinking about, okay, what's my junior internship going to be? Because junior internship never used to be as important as it is now. Unfortunately, most sourcing of employees for Wall Street, investing, banking, whatever it is, are relying, the ones who hire new people out of college, and not everyone does, but for those firms that do it, they're really relying on the junior internship. Now, why is that? Well, first of all, it's because other firms are doing it, and so everyone has this fear that if they don't recruit for junior internships, all the great people are going to be gone. So we all know it's bullshit, but the fact is that's the fear, and so that fear creates this need that everyone has to do it. The practical of it is that I will say, interviewing, and I've interviewed thousands of people, and I've interviewed for decades, and I'm not saying I'm the worst interviewer of all time, although I could be, but I have no idea. Like after you sit interviewing somebody for an hour, you know nothing. I mean, you know nothing. What could you possibly know? They've been prepared. I could ask you a really, interesting thought question. I could have a view of whether you're smart or you're not. I could have a view of whether you're going to work hard or not. I could ask you, okay, well, what's the most disappointing? I could ask you a lot of questions. I could be the best interviewer, and as I said, I'm arguably the worst. But there's no way you could know anything. But when you have somebody for an entire summer, you really do know at the end of the summer whether they are good, whether they are not, whether they're smart, whether they're not, whether they're going to work hard or not. And it's a little pretend, because definitionally they're going to work harder and do more than they, in that, what is in essence a tryout or a chance to figure out. But the at least you get 6, 8, 10, 12 weeks, depending on the program, to get a look at them. So it started with this just competition for hiring people, but it's actually now got a practical result. And so what that means is that to get a job at a lot of these places, you're talking about getting a job as a junior, in between your junior and senior year, as an intern, which seems very early and very unfair, but it's just how it works. We get, I don't even know, we must get 1,000 resumes, and we hire 12 to 14 people for our junior. And then we hire 10 to 12 of them for the full-time job. And if we hire 10, that means we have 2 slots for somebody that we don't know, who's usually somebody from a sophomore that we hired after their sophomore year that we knew previously. So it's just really hard nowadays, which just means you have to start earlier and you have to work hard. The jobs exist. Places hire people. Banks have openings that open up over the course of junior and senior year. Places like us end up with a class of 8 or 9 and they're looking for 3 or 4 instead of 0 or 2. But it means that you need to be prepared earlier. It means you need to be outreach earlier, and it means you have to take advantage of whatever you have, right? I've heard people who say, I want to get this job myself without the help of a friend or a parent or a professor or this or that. There's just one word for that: stupid. Because the fact is that these jobs are hard to get. Great jobs are really hard to get, and you need to use everything at your disposal. Career placement group, professors who might be able to write you a great recommendation so you can reach out to somebody. Whatever it is, you want to do as much of that as you can, because the jobs in finance and Wall Street are competitive, and there's a lot of places that are looking. A lot of people are looking for that, and a lot of places that are looking for that job. From our perspective specifically, unbelievable. I'm sure it will shock everyone in this room. Oak Hill just started recruiting at Olin this year. I can't tell you why, but we're starting to recruit for juniors internships, and so you have to, in situations where there are other places maybe that don't recruit here, you have to reach out. You got to figure out a connection. You got to look on LinkedIn. Do you know somebody? Is there a way to make that? It takes a lot of effort, and that effort is hard.
Amazing. So last question before we open it up to Q&A for the rest of the group. Specifically for Oak Hill, how can this group of students get in touch, and what does the process look like for recruiting for maybe their junior summer or something?
Well, there's a not that I'm supposed to advertise this, but that's actually a planted question, I'm guessing, from my HR person. So I'm coming back in November. What is it?
November 14th?
November 14th.
Is that right?
I'm coming back on November 14th, and I'm presenting Oak Hill. And you guys will obviously have an advantage because you've heard enough. You've heard at least a little bit, but I'll definitely be presenting Oak Hill as an opportunity. And then we're going to have some of our HR people talking, and then I believe we're going to do a set of interviews at some point in the spring. Candidly, come on the 14th if you're interested, because I don't. You as bad of an interviewer as I am, I'm probably just as bad as a recruiter. So there'll be somebody who will be able to answer all those questions. But that's sort of how it's originally started. We have not traditionally hired that many people from WashU. We've had a few, and of our 125 investment team members, we have 1 from WashU. We have 2 on our investor relations marketing team, which is actually, as a percentage matter, actually a very respectable number. 1 out of 125 is obviously much less respectable. And we're increasing that, and what you're finding is that everyone is broadening where they go and who they touch. And so a lot of firms, I'm guessing you're going to start seeing that at WashU a lot, which is more and more firms are going to start coming as they look deeper and broader to find talent.
Amazing. Well, thank you so much. And yeah, a good job.
Do we have time for Q&A, or are we?
So I think maybe if we could end it at 4:55 to give students the chance to go for other commitments, exams, etc.
I have no idea what time it is.
Yeah,
there it is.
yeah.
I'm just blind.
Yeah, so
I thought that was counting how many people were in the room.
well, you can keep the questions brief so that we can get multiple
Yes,
questions
because
in.
definitionally, as you've learned, my answers won't be. So maybe try to keep your questions brief. Yeah.
Sorry, you kind of talked about like jobs are fun and which you find not fun. You know, choosing which job is next. What parts of private credit do you find fun, like specifically?
Oh, so private credit, from my perspective, and credit overall, I've actually always found fun. And somebody asked me last night. We had a dinner. I don't know if you I don't know, did you come to dinner last night?
I think I did.
Yeah, so in the left, upper left. Yeah. So, and somebody asked me the difference between sort of the sports and credit and what I would have enjoyed and do I regret sort of missing out on the sports given how much of a sports fan I am. And I said my best friend from Michigan went into sports and was very senior in the Phillies organization, number 2 person on the business side. And he loves his job and he loves the fact that he goes to 81 home games a year and he goes to the playoffs when they make the playoffs and everything about the sports part. But his job is very repetitive, right? It's sort of the same job every year. He's been doing the same job for 30 years and he's gotten promoted in a variety of ways. But for the most part, if he doesn't get promoted, doesn't change his job is exactly the same. It's a different team. They might do well, they might do poorly, all this sort of stuff. But his job is in essence the same. When you're doing credit or investing, and I'll broaden the question just because private credit is sort of just indicative of the whole thing. Every day is different, right? Let's just assume I was only allowed to invest in one company. Well, that one company has got a different management team 5 years later. It's got different performance. It's got different drivers. It's got different competitors. The markets are different. What's the most important market?
I can't.
Rates. Come on, rates. We're talking about the rates market. So rates are different. Where's treasuries? Where's everything? The fact is everything is different, even for the exact same thing. I'm looking at providing a loan to this exact same company. There's 25 variables that are different in that situation. And those exact same things don't exist, right? It's not going to be the same company. It's not going to be the same situation. Maybe they're doing M&A. Maybe they're doing this and that. So what I love about what I do is that it's always different. There's nothing the same. Some of the skills are the same, but what I actually look at is always different, and that's what I love. I actually don't find any part of the investing to be boring. I actually like the investing. It can be stressful. You make a mistake, and I've made a lot of mistakes. And if we had another session, we could just talk about the mistakes of Alan Schrager, the investment mistakes of Alan Schrager. That would fill up at least an hour. But the fact is that the part of investing is really interesting. The part that's boring is your job's going to stink. Your first job is going to stink, right? It just is because you're being hired to lever the person who they hired the year before so they can start doing more interesting things so they don't leave. And so our first years don't necessarily love what they do, which is why I think you have to start with loving it. And then you have to start with, okay, this is just another year of school. I got to learn because that's the way I move up and I get out of the crappy part of the job. So I don't have that, right? I get to choose what I do every day. And the only thing I do that stinks, and I don't have a choice, is I love mentoring. I love stuff like this. I love talking to people individually. I like advising. I'm guessing my son would say I like advising way too much and giving my opinions and my recommendations way too much. But the fact is I love that stuff. What I hate is managing. Managing stinks. And there are some people who are great at managing, and there are some people who love managing. But when you are in an investment firm, and most of managing is people walking into your office and saying, when am I going to be in your job? How much more money am I going to make? What's my career path? I'm 22 years old. Where am I going to be when I'm 40? And I'm like, why don't you focus on what you're going to be 22 and a half, and then we'll figure it out. But for the most part, managing the team is a lot less fun than mentoring the team, and they are different. You do them together, but they're different. So that's the part of the job that I don't particularly care for, but that's not private credit. The investing part I love altogether, and I ended at 455.
Amazing. Well, thank you so much for your time. Let's give it a round.